Welcome to the Prosperity Pulse Point. Today, we're diving into something that could seriously change the way you think about investing and your financial future. We're talking about the Schwab US Dividend Equity ETF, better known as SCHD, and how much you'd really need to invest to live off its dividends. At the end of this video, we'll also cover some alternatives to SCHD, so let's get started. So, for those of you who might not be familiar with SCHD, it's one of the most popular dividend-focused ETFs out there. It was launched back in 2011, and it's designed to track the performance of the Dow Jones US Dividend 100 Index, which focuses on high-quality, dividend-paying companies. Right now, SCHD boasts a very competitive dividend yield, sitting around 3.5% at the time of recording. Plus, it comes with an impressively low expense ratio of just 0.06%. That means more of your money stays in your pocket. We'll dig deeper into how these dividends stack up, but that's the quick rundown of SCHD. Simple, effective, and affordable. Chapter 1. Understanding Living Off Dividends. What does living off dividends mean? So what does it actually mean to live off dividends? Essentially, it's when the income you receive from dividend payments covers your day-to-day living expenses. No need to sell off assets, no dipping into savings. Your investments generate regular cash flow, almost like getting a paycheck just for holding shares in the right companies or funds, like SCHD. What's key here is that you're living off the dividend income without touching the principal investment. In other words, your initial investment stays intact, while you collect regular dividend payments that you can use to pay for everything. Rent, groceries, utilities, you name it. It's a pretty appealing idea, right? The challenge, though, is figuring out exactly how much you need to invest to generate enough income to fully support your lifestyle. Now, it's not as simple as just investing a random amount and hoping for the best. You need to be clear about how much income you need to cover your living expenses. Which brings us to the next point. Setting a realistic living budget. First things first, everyone's lifestyle is different. The amount you need to live off dividends will vary depending on where you live and how much you spend. Let's start with some ballpark figures. According to national averages in the US, a modest lifestyle for a single person could cost around $30,000 per year, give or take. If you live in a major city or have a family, that number could easily rise to $50,000 or even $60,000 a year. On the other hand, if you're living in a more affordable area or have a minimalist lifestyle, you might be able to get by on something closer to $30,000 or $40,000 annually. For the sake of simplicity, in this video, we're going to focus on 4 main budget scenarios: $30,000, $40,000, $50,000, and $60,000 per year. These could cover a wide range of potential lifestyles, from more frugal living to moderate comfort. The question is, how much SCHD do you need to own in order to produce that kind of income every year? And more importantly, how sustainable is it? Chapter 2. The Math Behind SCHD Dividends. SCHD's historical and current dividend yield. Alright, now let's dig into the numbers and do some quick math to see how much income SCHD can actually generate. First, let's talk about the most important figure here, the dividend yield. As of today, SCHD's dividend yield is hovering around 3.5%. Now, for those of you who are unfamiliar with the term, the dividend yield is simply the annual dividend payment you receive, expressed as a percentage of the current share price. So, for example, if you invest $100,000 in SCHD, and the dividend yield is 3.5%, you'd receive around $3,500 in dividend income over the course of a year. This calculation is straightforward. Just multiply your investment by the dividend yield to get your annual income. If SCHD's yield is 3.5% and you've invested $100,000, then your annual dividend income will be $3,500. It's important to remember that dividend payments are typically paid out on a quarterly basis, meaning you'd receive smaller payments every 3 months. So in this case, you'd get around $875 every quarter. It may not sound like much, but those payments can add up over time, especially if you have a larger investment. Calculating the minimum investment required. Now that we've got the basics down, let's take a closer look at how much you'd need to invest in SCHD to fully cover your living expenses. The formula is simple. Your investment required equals your annual income goal divided by the dividend yield. Let's walk through a few examples. For a $30,000 annual income goal, here's how the math breaks down. You take $30,000 and divide it by the 3.5% dividend yield of SCHD. This gives you a required investment of approximately $857,000. So if you want to live off $30,000 a year purely from SCHD dividends, you would need around $857,000 invested in SCHD. Let's try the same math for $40,000 annual income. If you want $40,000 from dividends, you would divide $40,000 by 3.5%, which gives you about $1.14 million. For a $50,000 annual income, you'd need around $1.43 million invested. And for $60,000 a year, you'd need roughly $1.71 million. Here's a quick look at the numbers. As you can see, the more income you need, the larger your initial investment has to be. It's important to note that these numbers assume a constant dividend yield of 3.5%. In reality, that yield may fluctuate based on market conditions, and you also have to factor in things like taxes and inflation, which we'll talk about shortly. But for now, this gives you a solid foundation for understanding how much you'd need to live off SCHD dividends at different income levels. Chapter 3. Factoring in real-world variables. Considering inflation. Now that we've covered the basic math behind living off dividends, let's add a layer of realism. One of the biggest factors you need to account for when planning to live off dividend income is inflation. Inflation is that slow, steady rise in the cost of living, and over time, it can seriously erode the purchasing power of your money. Historically, inflation in the US has averaged around 2 to 3% per year. That might not sound like much, but even small inflation rates can have a big impact over time. For instance, what costs $30,000 today could cost over $35,000 in just 5 years if inflation averages 3%. If your dividend income stays the same while your living costs rise, you'll find it harder and harder to maintain your lifestyle. That's where SCHD's dividend growth comes into play. The good news is that SCHD has historically grown its dividend payouts. Over the past several years, the fund has seen an annualized dividend growth rate of around 9 to 10%. So, in theory, if SCHD continues to grow its dividends at that rate, it could more than offset the effects of inflation. This dividend growth acts as a hedge against inflation. If your dividends are increasing faster than the cost of living, your purchasing power should actually improve over time. But remember, as I always say, past performance doesn't guarantee future results. Taxes and fees. Now, let's talk about another factor that can eat into your dividend income. Taxes. Dividends are considered taxable income, and depending on your tax bracket, that can have a significant impact on how much money you actually keep. The good news is that SCHD pays qualified dividends, which are generally taxed at a lower rate than regular income. For most individuals, the tax rate on qualified dividends falls between 0% to 20%, depending on your income level. This is lower than ordinary income tax rates, but it's still something to consider when calculating your net income from SCHD. For example, if you're in the 15% tax bracket for dividends, that $3,500 annual dividend income we mentioned earlier might shrink to around $2,975 after taxes. The higher your tax bracket, the more taxes you'll have to pay. On top of taxes, you also need to factor in fees. SCHD has a very low expense ratio, just 0.06%. This is one of the lowest in the industry, which is great because it means more of your returns stay in your pocket. But no matter how low the fees, they still take a small bite out of your total return. SCHD's performance over time. Finally, let's talk about the performance of SCHD over time. Since its inception in 2011, SCHD has not only provided consistent dividend payments, but it also has seen impressive overall performance. This means that in addition to receiving regular income, your investment may also appreciate in value. For instance, SCHD has delivered an average annual total return of over 12% since its launch. This includes both the price appreciation of the ETF and the reinvested dividends. Of course, market conditions can change, and past performance isn't guaranteed to continue, but SCHD's track record is solid. Chapter 4. SCHD's performance over time. So, we've discussed the numbers, but what about the long-term sustainability of living off SCHD dividends? Let's take a deeper look into SCHD's historical performance and what that might mean for the future. Since its inception in 2011, SCHD has built a reputation for consistent dividends and solid total returns. Its performance has averaged over 12% annually, combining both capital appreciation and dividend payments. This means that, on top of collecting dividends, the value of your investment could increase as well, something that could provide a cushion for your financial plan. This combination of dividend income and capital growth has helped many investors grow their wealth over time. And for those who choose to reinvest their dividends during their accumulation phase, the compounding effect can significantly boost the size of their portfolio. But it's also important to remember that markets are unpredictable. There will be years when SCHD outperforms, and there will be years when it underperforms. The key is to stay patient and maintain a long-term view. Relying on dividends for income means you have to be prepared for fluctuations in the stock market, particularly during recessions or downturns, when dividends could be reduced or paused. Chapter 5. Alternatives. One popular alternative is Vanguard High Dividend Yield ETF, or VYM. Like SCHD, VYM focuses on companies that pay high dividends, but it has a broader selection of holdings and a slightly different sector allocation. VYM currently offers a competitive yield, and its expense ratio is also low, sitting at 0.06%, making it a solid choice for income-focused investors. Next up is the iShares Core Dividend Growth ETF, or DGRO. This ETF focuses more on dividend growth rather than just high yields, which can be appealing if you're looking for dividends that increase steadily over time. DGRO has a slightly lower yield than SCHD, but focuses on companies with strong fundamentals that are likely to raise their dividends consistently. Another option is iShares Core High Dividend ETF, or HDV. HDV offers exposure to U.S. companies with relatively high dividend yields, but leans more heavily into sectors like utilities and energy. This ETF might appeal to those looking for higher current income, though it does carry more concentration risk in certain industries. Each of these ETFs offers its own strengths, so it's worth considering how they fit into your overall portfolio strategy. Whether you prioritize yield, growth, or diversification across sectors, exploring these alternatives can help you build a balanced income-generating portfolio. If you found this video helpful, don't forget to hit that like button and subscribe for more in-depth financial content. And if you have any questions or thoughts about your own dividend strategy, drop them in the comments below. I'd love to hear from you. Thanks for watching, and until next time, keep investing wisely.